Today's topic is ratio analysis. And when you talk about ratio analysis, are you there? Are you there? When you talk about ratio analysis, it refers to as the study or analysis of line items presented in the financial statement, or it is a quantitative method of gaining insight into the company's liquidity, operational efficiency, and profitability by studying the financial statement. So what we're saying in essence is this. Ratio analysis is just to gain insight on how a company fared in terms of its operations. That's why we have ratio analysis. So for the different kinds of ratio analysis we have the financial ratios, we have the profitability ratios, we have the liquidity ratios, we also have the gearing ratios. But right now we need to talk about financial ratios and profitability ratios. So for financial ratios, I wrote, financial ratios are created with the use of numerical values taken from financial statements to gain meaningful information. So for financial ratios, we get them from, they are numerical values, they are figures that are extracted from our financial statement. So it allows us to gain a meaningful information on how the financial statement of the company is. And for profitability ratios, I wrote, these are financial metrics used to assess the business's ability to generate profit relative to its revenue, operating costs, and balance sheet over time. So for the profitability ratios, we used it to understand the extent at which a company fares in terms of the ability to raise, the ability to generate revenue. That is what profitability ratios is about. So the firm would generate revenue, and in course of generating revenue, we want to know how good the firm is in terms of its profit margin. So how do we calculate the profitability ratio or the profitability ratio of a company? We can calculate it through the gross profit margin or the net profit margin. So we start with the gross profit margin. For the gross profit margin, it is your gross profit multiplied by 100 divided by revenue. How do you get your gross profit? Your gross profit is your revenue minus your cost of sales. So to get the gross profit, it is revenue minus the cost of sales. Then to get your gross profit margin, it is gross profit multiplied by 100 divided by the revenue. And we have the profit for the year, which is the same as the net profit. For the net profit, we can also get the net profit margin, which is the net profit before tax divided by the revenue multiplied by 100. How do we get the net profit before tax? It means our gross profit minus all revenue, our gross profit minus all overhead costs, overhead expenses, like the administrative expenses, the transportational expenses, office expenses, which is the same as administrative expenses, whatever expenses we incur, we get to take it away from our gross profit. That gives us our net profit. So for the net profit, it is net profit before tax divided by revenue multiplied by 100. That is about gross profit and net profit. Then we have this analysis in the work example. For 2017, we have 48,660. We have the revenue for a company for 48,660. We have the gross profit, we have the operating profit, and we have the profit for the year. So for the profit for the year, the operating profit, here we have, if you have to find the gross profit margin, it is, like I told you earlier, the gross profit margin for 2017 will be gross profit, which is 21,890, divided by the revenue, which is 48,660, multiplied by 100. That's how we get our gross profit margin. So here I wrote about gross profit margin. I said, okay, that's about gross profit margin. Then for the net profit margin, we have our net profit before tax. That's from our operating profits. All right, let's just go to interpreting the profitability ratios. For the gross profit margin, I wrote, higher gross margin means that more profit is being made per each sales. So when a company is having a high profit margin, it means the company is making more sales, because the higher your sales, the higher the gross profit you're going to have, which will also reflect on the gross profit margin. If your gross profit is high, that means your gross profit margin will also be high. So how will your gross profit be high? Your gross profit will be higher if your sales increases. So for the interpretation of the gross profit margin, I wrote higher gross margin means that more profit is being made per each sales. That's about the gross profit margin. Then for the net profit margin, which is the same as net profit before tax, I wrote net profit margin focuses on the bottom line of the business. And when you talk about the bottom line of the business, this implies that it shows the profit that is left after all deductions have been made. We call it the bottom line because the net profit margin will only show us the profit we have at the end of the year when we have deducted all deductions, all that we have to deduct. We have taken them away from our gross profit. So that's why we call it the bottom line. That's the least, that's the end, that's the bottom tail, where you reach. And when you are getting to that point, it means you have paid all your dues as a business. So whatever is left will be your profit. So that's about net profit. Then we go to liquidity ratios. For liquidity ratios, I wrote, it measures a company's ability to pay debt obligation. So a company will definitely have liabilities. So the liabilities a company has, basically when you talk about the liquidity ratio, because liquidity means ability to turn to cash easily. So for liquidity ratio, it measures the ability of a firm to be able to pay its short-term debt. That is what liquidity ratio is about. So here we have two types of liquidity ratio. We have the current ratio, we have the acid test ratio. For the current ratio, it is your current assets divided by your current liabilities. What are your current assets? You have your cash at bank, your cash at hand, you have your stocks, which is the same as inventory, you have your debtors. When you sum all this together, you divide it with your current liabilities. What are your current liabilities? Your current liabilities are your trade creditors, the overdraft you take, because they are short term. So everything about liquidity ratio is about the short term. So when you talk about the short term when you talk about the short term liabilities, we're talking about liabilities that have to be paid within a year. So we have trade creditor, the supplier that you have to pay, that you bought on credit from. You have an overdraft, a bank overdraft. What's a bank overdraft? A bank overdraft is a credit facility that allows a bank customer to withdraw more than what he or she has in his or her bank account. So let's for example, you have 500 dinars or $500 in your bank account, and you needed $700. You could get an overdraft from the bank of $200. So instead of taking 500 as your credit, instead of taking the 500 in your credit account or in your credit balance, you'll be able to take 700. The 200 you are able to take afterwards, it's your bank overdraft. Are you getting it, please?
Yeah.
All right. Then we have the acid test ratio. For acid test ratio, it is your current assets minus your inventories divided by your current liabilities. Current assets minus inventories divided by current liabilities. How do you get your inventories here? We're talking about the average inventory, which is your opening inventory plus your closing inventory divided by 2. And that's how you calculate your acid test ratio. For current ratio, it is your current assets divided by your current liabilities. For your acid ratio, it is current assets minus inventories divided by current liabilities. So how do we interpret liquidity ratios? For the liquidity ratios, so here I wrote current ratios. A business is said to have interpretation now. Before we go to the case study, the interpretation of it. Okay, yeah, I wrote, a business is said to have enough liquid resources if the current ratio is below 1:1.5 ratio 1 and 2 ratio 1. What I'm saying is, if your gross profit margin is between 1.5 ratio 1 to 2 ratio 1, it means the company has the ability to turn its debt, to pay up its debt within a short period of time. What I'm saying is that if you calculate your current ratios and what your result is about is between 1.5 to ratio 1 or 2 ratio 1, it means that the business may not have enough working capital. So what it's simply saying is that if you have 1.5 ratio 1 to 2 ratio 1, if it is below 1.5, within 1.5 to 2.1, you are fine as a business. But if it's below 1.5, it means you are not doing well as a business. That means you don't have the ability to pay your debt within a short period of time. Do you understand what I'm saying here?
Yeah.
We're talking about the interpretation. Between 1.5 to 2, it means that the company is doing well. It can pay up its short-term debt within that period of time. But if it is below such amount, it means that the business does not have enough capital, working capital. So it could be as a result of what? When the business is having a less than 1.5 current ratio, it could be that the business is over trading or is over borrowing. Do you get what I'm saying here? Hello? Hello? I'm going to repeat that again. I said, if the current ratio of a business is less than 1.5, it simply means that the business is not doing well. It doesn't have enough working capital, simply because the business is investing on unproductive, is using the money unproductively. That means it's not going to be able to pay up its debt within a short period of time. And what could cause such situation? It could be as a result of overborrowing. The company is borrowing too much, or over trading, which means the company is investing on unproductive operations. For acid test ratio, I wrote, if a business has an acid test ratio less than 1 ratio 1, it means that its current asset minus stock do not cover its current liability. So if your acid test ratio is less than 1 ratio 1, it means when you take away your current asset from your stock, you don't have enough money to cover for your liabilities. Remember that for the acid test ratio, it is current assets minus stocks divided by current liabilities. So if you take away your current assets, if you take away your stocks, inventories from your current assets, and it is less than 1, that means you won't be able to cover up for your current liabilities. But if it is more than 1, then it is fine for the business. That is the interpretation of acid test ratio. Then you have the activity 1. But before going to the activity 1, I will quickly explain gearing ratio. For gearing ratio, I wrote, it shows the long-term financial position of the business. So for gearing ratio, what do we use it for? We use the gearing ratio to know the extent of debt a business is having when it comes to its financial position. So here I wrote, it shows the long-term financial position of the business. So how do we calculate our gearing ratio? It is non-current liabilities divided by capital employed multiplied by 100. For your gearing ratio, it is non-current liabilities. And when we talk about non-current liabilities, we are talking about long-term liabilities. which could be debentures or mortgage loan, divided by the capital employed, the amount of money invested into the business from shareholders and the rest, multiply by 100. That gives you your gearing ratio. So for the gearing ratio, what do? This is the interpretation. It assesses whether a business is burdened by its loans. So for gearing ratio, so for the interpretation of the gearing ratio, I wrote, it assesses whether a business is burdened by its loans. If you have a less than 50% or relatively low, okay, let me say gearing ratio less than 50% are relatively low, which means the business is not relying mostly on loans. So if your gearing ratio is high, it means you are burdened with a lot of loans. That means the business is relying on loans to keep its business or to keep its operation. That's why a business would have a high gearing ratio. But if a business is having less than 50% gearing ratio, it means the business is not burdened with loans. That means the business is using maybe shareholders' fund or reserves that it has for its operation. But whenever a business rely mostly on loans, it's going to have a high gearing ratio. And as a result of that, it's not good for the business. The business might shut down. So that's why I wrote that. Again, look at the formula. It's non-current liabilities divided by capital employed multiplied by 100. So your non-current liabilities, which are your loans, when you divide it with your capital employed, and you're having a less than 5% or less than 50%, then it means that you are bothered with a lot of loans. That means the business is over borrowing. It means that the business is relying so much on borrowings for its expansion or for its operation. Is it clear? Is it clear, please?
Yes.
All right.
Yeah.
So that's all about that. So you do the activity now. Activity 1 and activity 1, yes. And activity 2.